This week's commentary is entitled, Is it the boat or is it the weather? Where we give you a framework for how to understand and evaluate investments. So this week in the commentary, is it the boat or the weather? We want to frame up a few things and really hopefully bring some more clarity to the common questions investors have of all sorts, which is, how do I know how it's going? How do I know when it's time to make a change? Is it the thing that I'm in that's not working, or is it simply the environment in which it's in? And that's one of the biggest things right up front we want to talk about. Again, it is understanding that environment. We'll run into prospective clients who are like, yeah, I feel like I did pretty good last year, who are up 6-7%, when maybe from their risk tolerance of their portfolio, they should have been rewarded a lot more. Or conversely, a client could be down, but not nearly down as much of the market, and that portfolio manager have done a really good job buffering risk. So it isn't just as simple as, did I go up or down? Although we clearly like the former more than the latter as investors. Really understanding, again, evaluating the vessel, not how much we've liked the environment we're in, is about relative performance. How have you been paid, or have you been protected in light of the risk that you're taking within your portfolio? If we're not going to be focused on the vessel, we'll go with some of the trips before we get to how to build. A lot of times people are looking at trying to predict weather. They get frustrated. That sailboat, if you will, has been sitting there with no wind in it for some time, and they're going to make a big call about where they think things are going. Found this chart about 2023 for a S&P that surprised everybody and finished up over 4,700 last year. The average return expectation was for the market to finish last year around 4,000 from most big houses, actually sub 4,000, and nobody was predicting the market was going to end up that high. There's plenty of examples, good, bad, and otherwise, but the point is the ability to predict, as we've said time and time again, is not the consistent path to success, but rather process. Second is chasing the wind. So there's your boat stuck in this doldrum of a market. Well, maybe we ought to chase the wind. This is really the second danger, if you will, outside of trying to be predictive, which is chasing performance. There's a reason this disclaimer is on virtually every investment put out there, which is past performance is not indicative of a future success. There's the famous story of Peter Lynch's fund back in the day. He had an epic run where he averaged 29% over a couple decades, and yet the average investor, Fidelity, who oversaw the fund, put out this story, actually lost money. How is that possible? Well, it wasn't 29% every year. And when he would have a gangbuster year of, say, 50%, people would come piling in, only to be disappointed by the next year's performance and go bailing out and repeat that pattern. That's the pattern, again, we want to avoid as investors. We want to be diversified from both an emotional and a financial perspective. But again, if we've got that sound vessel, we don't want to be in the predictive or chasing the weather type regime. We want to be patient, stay the course, wait for our day to come. The second thing about chasing the wind, to wrap this point up, is clearly it's changing its location all the time. As relates to markets and just that fallacy of changing what's worked, as a stock does well within the S&P 500, its capitalization, how much of the S&P it represents, goes up and up and up. If we look back from 2000 into present, there's only one name, which I am not permitted to say, that is the same. 80% of those names have turned over. I'm sure if you looked deeper down, you'd see even more turnover. So again, what had been the best 5 names, rising them to the top of the index back in 2000, have all but changed, and new names have replaced them. Talking about concentration risk, talking about that danger. When you look at just the index in general, back even when those 5 names in 2000 were there, they represented about 10%. This is the next chart you'll see popping up. Today, the top 5 names represent 25% of the index, an all-time high. So if we're not to try to predict and we're not to try to chase and pile into what has been working, especially when it's as concentrated as it is today, trading at valuations, how do we build then a winning portfolio or know that we're doing well? Well, number one is, as I alluded to a moment ago, find a win. One of the big parts about diversification is, again, having some aspect of your portfolio that hopefully is working at all times or in all conditions. This could just be from an emotional perspective, so you don't feel like just giving up on being an investor in general, but it's also important for those unexpected needs, costs that come along, that you have something that you're not having to sell at a loss or at an inopportune time. Second is to rebalance from strength to where you can find value. If you look at value stocks today, as the name happens to correspond with, they're only trading at 11.6 times earnings versus for growth stocks 25.7. So when you're looking at things, valuation is not a catalyst. It doesn't mean it's right for all people. But again, most of the time, to do the thing that we're going to look back on and be proud of, that's going to have been productive, is going to take a moment of courage and a little bit of patience, as we might look foolish, to eventually see that value recognized. That's what buying low is all about. And then again, having the equal courage to sell high. With that, if you ever need help understanding how your vessel is looking in light of the environment or your overall portfolio, we're always here to help. And we hope you found this information useful in creating, again, a broader context to make those decisions.